Imagine you've spent decades building your retirement savings. You finally have a portfolio worth $250,000, $500,000, maybe even $1 million. Then suddenly, the biggest IPO in history arrives. Everyone is talking about it, financial news is covering it, your friends are asking about it, and one question keeps coming up. Should I buy SpaceX for my retirement portfolio? Today, we're going to break down exactly what SpaceX is, why investors are excited, the risks nobody is talking about, and how retirees should think about opportunities like this. Because sometimes the biggest investment opportunities can also become the biggest mistakes. Why everyone is talking about SpaceX? SpaceX isn't just another company. For years, it was one of the most valuable private companies in the world. Now public investors finally have a chance to own it. Think about what SpaceX has accomplished: reusable rockets, commercial satellite launches, government contracts, Starlink internet, human spaceflight. A decade ago, many people thought these goals were impossible. Today, they are reality. That's why investors are so excited. When people hear SpaceX, they don't think about today's business. They think about Mars, global internet, future technology, artificial intelligence infrastructure, defense contracts. They see decades of potential growth, and that's exactly what creates both opportunity and risk. The retirement investor's dilemma. When you're 25 years old, investing can be simple. You have decades to recover from mistakes. But retirement investing is different. If you're 60, 65, or 70 years old, every decision matters more. You need growth, but you also need protection. And that's where stocks like SpaceX create a dilemma. On one hand, what if this becomes one of the greatest investments of the next 20 years? What if it doubles, triples, increases tenfold? Nobody wants to miss the next big opportunity, but on the other hand, what if expectations are already too high? What if the stock falls 40%, 50%, 70%? That possibility exists too. Retirees don't just need returns, they need to protect what they've already built. The fear of missing out. One of the most powerful forces in investing is not greed, it's fear. Specifically, the fear of being left behind. Many investors remember stories about people who bought companies like Amazon, Apple, Nvidia, or Tesla early and became wealthy. These stories are everywhere. What we don't hear nearly as often are the thousands of companies that looked promising but never delivered. When a company like SpaceX goes public, investors naturally begin imagining what could happen if the company continues growing for another 10 or 20 years. The headlines become irresistible. The media coverage becomes constant. Every conversation seems to revolve around the same question: what if this is the next trillion-dollar opportunity? This is exactly when investors need to slow down, because investing based on fear of missing out can lead to expensive mistakes. A retirement portfolio should never be built around excitement, it should be built around probability. To understand SpaceX, let's look at another Elon Musk company, Tesla. Many investors who bought Tesla years ago earned extraordinary returns. Some transformed relatively small investments into life-changing wealth. But that's only part of the story. What many people forget is how difficult the journey was. Tesla experienced enormous volatility. The stock repeatedly experienced major corrections. Many investors sold during periods of fear. Others bought near peaks and waited years to recover losses. The lesson isn't that Tesla was a bad investment. The lesson is that even great companies can be emotionally challenging investments. Retirees need to understand this reality before buying any high-growth stock, because volatility feels very different when you're retired than when you're 30 years old. What happens if SpaceX succeeds? Let's assume the optimistic scenario. Imagine SpaceX continues expanding, Starlink grows globally, launch contracts increase, new technologies emerge, revenue climbs dramatically. In this scenario, today's valuation might eventually look reasonable. Early investors could earn substantial returns. This possibility explains why many investors are excited. Innovation often creates enormous wealth, and few companies are associated with innovation as strongly as SpaceX. This is the bull case. This is what supporters see. And to be fair, it's not an unreasonable possibility. What happens if SpaceX disappoints? Now let's examine the opposite outcome. Not failure, just disappointment. This distinction is important. Many investments don't collapse. They simply fail to meet expectations. Investors often assume growth will continue forever. Reality is usually more complicated. A company can grow while its stock underperforms. Why? Because expectations were too high. The market isn't comparing SpaceX to the present. The market is comparing SpaceX to an extremely optimistic future. If that future arrives more slowly than expected, investors may become disappointed. And disappointed investors often sell. That's why even outstanding businesses sometimes experience major stock declines. What if you bought at the wrong time? Let's explore a scenario that doesn't get enough attention. Imagine it's 6 months from now. You've been watching SpaceX climb higher and higher. Everywhere you look, people seem to be making money. Financial commentators are bullish. Social media is filled with success stories. Friends and family are talking about how much they've made. Eventually, you decide it's time to buy. You invest a portion of your retirement savings. And then something unexpected happens. The stock falls. Not because the company is failing, not because the business is broken, not because rockets stop launching. It falls because the market suddenly changes its expectations. This happens all the time. In fact, it's one of the most common experiences investors face. A great company can still experience a 20%, 30%, or even 50% decline. The question isn't whether it's possible. The question is how you would react if it happened. Would you panic? Would you sell? Would you lose sleep? Or would you view it as a normal part of investing? The answer matters because investing isn't just about numbers, it's about behavior. Many investors believe they can tolerate risk until they actually experience it. It's easy to say you're comfortable with volatility when stocks are rising. It's much harder when your account balance is falling every day. Retirees need to think carefully about this because retirement changes the relationship we have with risk. When we're younger, we often have decades to recover from mistakes. When we're retired, preserving wealth becomes more important. That's why understanding your own emotional tolerance for risk may be just as important as understanding the company you're investing in. The problem with hot stocks. One of the biggest mistakes investors make is confusing a great company with a great investment. Those two things are not always the same. A company can be incredible, its products can be incredible, its leadership can be incredible, and yet the stock can still disappoint investors. That sounds strange at first, but it's happened many times throughout history. Why? Because stock prices don't simply reflect today's reality. They reflect expectations about the future. If expectations become too optimistic, even excellent results can disappoint investors. Imagine a student who normally scores 80%, then suddenly everyone expects them to score 100%. They take the test and score 95%. Objectively, that's a fantastic result, but people are disappointed because expectations became unrealistic. The stock market works in much the same way. The higher expectations rise, the more difficult they become to satisfy. That's why investors need to think carefully whenever a company becomes the center of attention. What happens if SpaceX succeeds? Let's assume the optimistic scenario. Imagine SpaceX continues expanding. Starlink grows globally, launch contracts increase, new technologies emerge, revenue climbs dramatically. In this scenario, today's valuation might eventually look reasonable. Early investors could earn substantial returns. This possibility explains why many investors are excited. Innovation often creates enormous wealth, and few companies are associated with innovation as strongly as SpaceX. This is the bull case. This is what supporters see, and to be fair, it's not an unreasonable possibility. What happens if SpaceX disappoints? Now let's examine the opposite outcome. Not failure, just disappointment. This distinction is important. Many investments don't collapse. They simply fail to meet expectations. Investors often assume growth will continue forever. Reality is usually more complicated. A company can grow while its stock underperforms. Why? Because expectations were too high. The market isn't comparing SpaceX to the present. The market is comparing SpaceX to an extremely optimistic future. If that future arrives more slowly than expected, investors may become disappointed. And disappointed investors often sell. That's why even outstanding businesses sometimes experience major stock declines. Let's talk about the reasons investors love SpaceX. First, rockets. SpaceX transformed an industry that barely changed for decades. Second, Starlink. Many analysts believe Starlink could eventually become as important as the launch business itself. Providing internet service around the world creates recurring revenue, and recurring revenue often receives premium valuations from investors. Third, government relationships. SpaceX works with NASA, defense agencies, and commercial customers. These relationships can create long-term stability. Fourth, innovation. Investors often pay a premium for companies they believe will dominate the future, and few companies have captured the public imagination the way SpaceX has. This is why excitement is so high. Now let's discuss the other side, because every investment has risks. One of the biggest risks is valuation. Sometimes great companies become poor investments when investors become too optimistic. A company can be wonderful, its stock can still disappoint. We've seen this throughout history: technology stocks, internet companies, electric vehicle companies, AI companies. At times, investors become so excited about the future that they ignore the price they're paying today. Another risk is competition. While SpaceX leads today, competitors continue investing heavily. Another risk is execution. Future growth depends on management continuing to deliver extraordinary results. And finally, there's volatility. Retirees need to ask themselves, can I emotionally handle a 30%, 40%, or 50% decline? Because exciting stocks often experience dramatic swings. The history of big IPO excitement. History provides fascinating examples. Every generation has its own version of the opportunity everyone must own. During the dot-com era, investors believed the internet would transform the world. They were correct. The internet did transform the world, but many internet stocks still collapsed. Why? Because great ideas do not automatically equal great investments. Price matters, valuation matters, expectations matter. Investors who remember this lesson often make better decisions when exciting opportunities appear. Whenever a company like SpaceX enters public markets, emotions run high. Excitement rises, predictions multiply, experts appear everywhere, and investors feel pressure to act immediately. But retirement investing isn't a race. You don't receive a prize for buying first. You receive rewards for making sound decisions consistently over time. SpaceX may become one of the greatest investments of the next decade, or it may simply become another reminder that expectations can sometimes exceed reality. This brings us to a question that doesn't get asked enough. What do retirees actually need from their investments? Most retirees don't need the next SpaceX. They don't need a stock that might increase tenfold. What they need is confidence. They need income. They need growth that keeps pace with inflation. And most importantly, they need a portfolio that allows them to enjoy life without constantly worrying about money. That's why I think investors sometimes spend too much time searching for the next big winner. The reality is that many successful retirements are built on consistency, diversified investments, disciplined saving, long-term thinking, and avoiding major mistakes. The financial media often makes investing look exciting, but successful retirement planning is usually quite boring. And that's actually a good thing, because boring often works. Boring doesn't generate headlines, but boring frequently generates results. There's a phrase I've heard many successful investors repeat over the years: the best investment is the one that lets you sleep at night. I think that's especially true in retirement. Many people assume successful investing means maximizing returns, but retirement planning is about much more than that. It's about creating a life where money supports your goals rather than controls them. Imagine two retirees. The first earns a slightly higher return but spends every day worried about the market. The second earns a reasonable return and rarely worries about their finances. Which one is truly wealthier? I would argue the second person, because wealth isn't just measured in dollars, it's measured in peace of mind. This is why every investment decision should be viewed through the lens of your overall retirement plan. Ask yourself, if this investment drops significantly, will it change my lifestyle? Will it affect my ability to pay bills? Will it force me to delay retirement? Will it cause unnecessary stress? If the answer is yes, the position may be too large, and that's an important lesson regardless of whether we're talking about SpaceX, technology stocks, AI companies, or any future investment opportunity. But as retirement investors, our goal isn't to predict the future perfectly. Our goal is to make decisions that allow us to sleep at night while still growing our wealth over time. The question isn't, should I buy SpaceX? The better question is, how much risk can my retirement portfolio safely handle? And once you answer that question, the right decision often becomes much clearer. Final question every retiree should ask: Before buying any investment, there's one question I believe every retiree should ask. Not, how much money can I make? But, what role does this investment play in my retirement plan? Is it meant to generate income, provide growth, protect against inflation, add diversification, or is it simply something exciting that everyone is talking about? There's nothing wrong with owning a stock because you believe in its future. But there is a problem when excitement replaces strategy. The most successful retirement portfolios are rarely built on a single prediction. They're built on a process that works regardless of whether the next hot investment succeeds or fails. And that's the mindset I would encourage every retirement investor to adopt when evaluating opportunities like SpaceX.